Stop everything. Put the coffee down, close the door, silence every notification, because what you're about to hear isn't market commentary, it's a line in the sand. If you miss this shift, you won't just underperform, you'll be operating inside a market that no longer exists. The rules you learned, the charts you trust, the assumptions that kept you comfortable are being erased in real time. Right now, most people are staring at screens, watching prices flicker, arguing about spreads between regions, debating whether a few dollars of premium really matters. They think that's the story. It isn't. That noise is just the echo of something far larger breaking underneath the floorboards. What matters isn't the number you see on the chart. What matters is who just stepped into the market and why. For years, we tracked the usual giants, the banks, the funds, the industrial buyers. We mapped their behavior, anticipated their moves, and learned how to survive alongside them. But today, every one of those players has been quietly pushed aside. A new force has entered the arena, and this one doesn't negotiate, doesn't hesitate, and doesn't care about price sensitivity. This is the moment when an asset stops being treated as a trade and starts being treated as infrastructure. When demand no longer asks permission. When buying becomes mandatory. And once that line is crossed, markets don't adjust politely, they rupture. This chapter isn't about hype. It's about recognizing the exact moment when a market transitions from choice to necessity, and once you see that shift clearly, you can never unsee it. If this perspective already feels uncomfortable, that's a good sign. It means you're paying attention. If you want to understand what's really happening beneath the surface and what it means for you, type 1 in the comments to continue and subscribe so you don't miss what comes next. Now let's talk about the moment the market truly broke, when the biggest buyer on earth stopped observing and started acting. For decades, traders believed they understood demand. Funds had budgets. Corporations had limits. Even the largest players were constrained by price. Push the market too far and buyers stepped back. That assumption is now obsolete. When a sovereign power enters a market with a mandate, not a target price, everything changes. This isn't speculation. This isn't portfolio allocation. This is procurement tied directly to national survival. In that world, price is no longer a signal, it's an obstacle to be bulldozed through. Here's what most people miss. The size of the physical market is shockingly small compared to the scale of institutional capital. What looks like billions on paper represents a massive percentage of real deliverable supply. This isn't about money flooding in, it's about material being removed permanently from circulation. Private buyers hesitate. Governments don't. When supply tightens, funds pause and reassess risk. Strategic buyers accelerate. They are not trying to optimize returns. They are trying to eliminate vulnerability. And when vulnerability is the metric, there is no ceiling. This is the psychological pivot point. The market is no longer asking, is this asset cheap or expensive? It's asking, do we have enough and what happens if we don't? That question overrides every valuation model ever built. Once that mindset takes hold, competition intensifies instantly. Industrial users rush to secure inventory before it's gone. Intermediaries front-run future scarcity. Hoarding replaces hedging. The feedback loop feeds on itself and liquidity evaporates faster than anyone expects. This is why surface-level price action is misleading. The chart reflects transactions from a world where supply was assumed to exist. That world has quietly expired. What replaces it is a market driven by fear of absence, not hope of profit. And once fear becomes the dominant force, the pace of change accelerates beyond linear logic. Scarcity doesn't creep in, it snaps. You're not watching a rally, you're watching a transition. To understand how fragile this system really is, you have to stop thinking in narratives and start thinking in math. Not forecasts, not opinions, arithmetic. Because numbers don't care about sentiment, and they don't lie to protect institutions. In a functioning market, physical delivery is the exception, not the rule. Most contracts are rolled offset or closed long before anything real is exchanged. That's how leverage survives. That's how paper markets remain stable. They depend on the assumption that very few participants will ever demand what they're owed. But when that assumption breaks, the structure collapses from the inside. There are periods on the calendar designed to absorb delivery quietly. Transitional months where activity should be minimal. When those months suddenly see outsized physical demand, it's not a coincidence, it's a warning flare. It means participants with deep insight are no longer comfortable with promises. They want substance. When tens of millions of ounces move during a period that's supposed to be dormant, you're not witnessing normal flow. You're witnessing a run. And runs don't reverse because confidence doesn't return once it's gone. Here's the critical variable: registered inventory. This is not theoretical supply. It's the metal that is certified, available, and ready to be delivered. Everything else is a story. And when that category starts shrinking faster than it can be replenished, time becomes the enemy. Divide remaining supply by the current rate of demand, and you don't get a debate, you get a countdown. Weeks, not years. This is why institutions with the best information are positioning aggressively. They're not guessing, they're calculating. The most dangerous part is that nothing in this process looks dramatic at first glance. Prices still trade, screens still update, commentators still argue about resistance levels, but beneath that surface, the foundation is thinning. This is how market failures unfold, quietly, methodically, mathematically. And by the time the average participant recognizes the pattern, the exit no longer exists. This isn't about predicting the future. It's about recognizing when the present has already crossed a point of no return. Once the math exposes the weakness, the next question becomes obvious: who is absorbing the supply? Markets don't drain themselves. Every ounce removed has a destination, and identifying that destination tells you everything about what comes next. When you examine the daily delivery data, a disturbing pattern emerges. Activity isn't dispersed, it's concentrated. One side is issuing metal under pressure, while the other is calmly taking everything offered. This isn't balance, it's extraction. This is where banking dynamics matter. In a paper-driven system, short positions work as long as delivery requests remain manageable. But when physical demand spikes, those shorts become liabilities that must be extinguished with real material. And real material is finite. What you're seeing is not competition, it's triage. Institutions with exposure are scrambling to plug holes while those with foresight are consolidating control. The flow of metal becomes one-directional. Once that happens, price suppression loses its power. Why would a single entity step in so aggressively? Because they understand the sequence. They know that once inventory hits a critical threshold, the rules change. Exchanges protect themselves. Contracts get reinterpreted. Cash replaces delivery. Whoever holds the physical at that moment holds the leverage. This is why the behavior looks extreme. It has to be. Waiting is not an option when scarcity is approaching at exponential speed. Every delay increases risk. Every ounce secured reduces vulnerability. The rest of the market sees price stability and assumes calm. Insiders see accumulation and understand urgency. This divergence between perception and reality is where most participants get trapped. And while attention remains fixed on domestic exchanges, another force is already pulling supply in a different direction entirely. One that doesn't rely on futures leverage or paper claims, one that responds only to physical imbalance. To see the full picture, you have to look beyond the familiar battleground. While attention remains locked on Western exchanges, the real pressure is building elsewhere. Physical markets don't respect narratives, they respond to incentives. And when a persistent price gap opens between regions, metal doesn't hesitate. It migrates. This is where arbitrage becomes the silent executioner. A difference of a few dollars isn't noise when margins are thin and supply is tight. It's a vacuum. Metal flows relentlessly toward the highest bidder, stripping liquidity from wherever it's cheapest. And once that channel opens, it's almost impossible to close without a violent repricing. Attempts to control this process rarely work. Regulatory limits position. Caps emergency directives. These tools assume demand is optional. They work when buyers can step back. But when buyers can't stop without shutting down factories, missing contracts, or losing strategic advantage, rules become suggestions. The result is a market sending a clear signal: price controls have lost authority. When restrictions are tightened and prices rise instead of fall, that's confirmation of stress, not stability. It means demand is structural, not speculative. This is the moment when the global system starts to fragment. One price exists on the screens, another exists in reality. And metal obeys reality every time. As supply is pulled eastward, inventories elsewhere thin faster than expected. What looks like a regional issue is actually a global rebalancing driven by necessity rather than profit. And once participants recognize that this flow is irreversible, behavior shifts instantly. Buyers rush, sellers vanish, dealers ration, premiums expand, availability becomes the metric that matters, not price. This is how localized scarcity turns systemic. It doesn't announce itself with headlines, it shows up as delays, limits, and temporarily unavailable notices. By the time the average participant understands what's happening, the physical market has already moved on. And now that stress is no longer confined to institutions, it's reached the point where even the retail layer can't absorb the pressure. This is where the story stops being abstract and starts becoming personal. When scarcity reaches the retail layer, it's no longer a theory, it's a lived experience. Shelves don't empty gradually. They go from available to restricted to gone faster than most people can react. Retail markets are built on flow. They depend on a steady stream of raw material coming in, being processed, minted, and shipped out. When that flow is disrupted upstream by institutional hoarding, arbitrage pressure, or strategic accumulation, the retail layer doesn't bend. It snaps. The first signal is rationing. Minimum order sizes appear. Smaller buyers are quietly pushed aside, not out of malice, but out of necessity. Processing single units becomes inefficient when inventory is collapsing. Dealers prioritize volume because survival demands it. This creates a brutal feedback loop. The moment buyers realize access is being restricted, demand spikes further. People who were waiting suddenly rush in. Those who planned to buy later discover later no longer exists. Scarcity accelerates itself. What's critical to understand is that these failures aren't caused by panic alone. They're the result of a system optimized for abundance encountering absence. Just in time, supply chains don't fail gracefully. They fail suddenly. When even the largest, best-connected retailers struggle to maintain production, it tells you the problem is not local, it's structural. The raw material isn't reaching them because it's being absorbed elsewhere by entities that don't resell, don't recycle supply, and don't release inventory back into the market. At this stage, price becomes secondary. Access is the constraint. And once access disappears, no chart, no contract, no promise can substitute for possession. This is the point where most people realize they were tracking the wrong signal all along. Now we need to put all of this on a timeline, because markets don't collapse randomly. They fail at intersections where math, behavior, and calendar mechanics collide. And once those pieces align, there's no flexibility left in the system. Delivery cycles matter. Certain periods are designed to absorb pressure, others amplify it, when inventory is already depleted going into a high-demand window. The outcome isn't uncertain, it's predetermined. You cannot deliver what doesn't exist. This is where legal language quietly takes center stage. Every futures contract contains clauses that most participants never read because they assume they'll never matter. They matter only when systems are stressed beyond design limits, and that moment is exactly what inventory exhaustion creates. When obligations exceed available supply, exchanges don't break rules, they invoke them. Cash settlement replaces delivery, not as a courtesy, but as a survival mechanism. The system protects itself first. From the outside, this looks orderly. Contracts are honored, payments are made, but the substance of the agreement is gone. Participants receive currency instead of material, even as real-world prices detach from paper references. This is the trap. On paper, everything appears functional. In reality, a split forms between representation and the substance. Those holding claims are settled. Those holding assets retain leverage. The timing of this shift is not vague. It's dictated by remaining inventory and upcoming delivery demand. As supply shrinks, the margin for error disappears. What was once improbable becomes inevitable. And once the system demonstrates it can't fulfill its core promise, delivery confidence doesn't return. Markets can survive volatility. They cannot survive broken trust. This is the point where the conversation changes from, is this bullish, to what still works. At this stage, the difference between paper and physical is no longer theoretical. It becomes the fault line that defines everything. What once traded as a single asset splits into two realities, one that exists on screens and one that exists in the real world. Paper prices can remain calm longer than logic allows because they are protected by structure. Margin rules, settlement clauses, and legal escape hatches preserve surface stability. Physical markets have no such protection. When metal is gone, it is gone. No rollovers, no substitutions. This is why price becomes deceptive. A stable quote creates the illusion of time even as availability disappears. People wait because the number hasn't exploded yet. But markets don't move when people agree. They move when constraints force them to. Once physical supply is locked away by strategic buyers or industrial necessity, it stops circulating. Liquidity collapses. And when liquidity collapses, price discovery doesn't drift. It snaps. The most dangerous moment is the transition period. Paper still trades freely while physical access is already restricted. This is where most participants make the fatal mistake. They assume convergence will favor paper. It never does. Either paper reprices violently or it becomes irrelevant. In both cases, possession wins. This isn't a failure of markets, it's a failure of leverage in a world of scarcity. And once that lesson is taught, it isn't repeated gently. What makes this moment especially dangerous is that it doesn't feel like a crisis yet. There's no panic headline, no trading halt, no dramatic collapse on the screen. And that false calm is exactly what traps people. They mistake silence for safety. Institutions don't wait for confirmation. They act on constraints. When timelines compress, behavior changes fast. Buyers stop optimizing and start securing. Sellers stop advertising and start rationing. The market doesn't freeze because of fear. It freezes because there's nothing left to exchange. This is where calendar pressure becomes lethal. As delivery windows approach, optionality disappears. Participants who could once roll positions forward are forced to make a decision, take cash or demand delivery, and when too many choose delivery at the same time, the illusion of abundance shatters. What follows isn't chaos. It's prioritization. Contracts are honored selectively. Access is determined by size, relationships, and strategic importance. Smaller participants aren't attacked. They're simply ignored. Not because they're wrong, but because they're irrelevant to survival decisions being made at the top. This is how financial systems protect themselves, not by fairness, but by hierarchy. And once that hierarchy asserts itself, the market you thought you were participating in no longer exists. The mistake most people make is assuming they'll be warned, that there will be time to react once things become obvious. But obviousness arrives only after positioning is complete. By the time the outcome is visible, it's already locked in. This is not about predicting collapse. It's about recognizing compression. When time supply and behavior converge, outcomes stop being flexible. They become mechanical. And once that mechanism engages, there are no second chances, only consequences. So we arrive at the only question that truly matters. Now, what do you do when a market stops rewarding prediction and starts rewarding preparation? At this stage, this is no longer about timing entries, reading indicators, or proving you're right. It's about positioning ahead of inevitability. When supply becomes strategic, volatility turns into background noise. Waiting for confirmation, hoping for a cleaner setup, or expecting one last pullback is a habit formed in a market built on excess. Scarcity does not provide polite signals, it removes choices. The core lesson is uncomfortable but unavoidable. Price is no longer the primary risk. Accesses. Paying more today may feel painful, but being unable to act tomorrow is fatal. In stressed markets, later is the first thing to disappear. This is why paper promises fail when pressure rises. They function when delivery is rare and trust is abundant. They fail when everyone reaches for the same exit at the same time. Physical control matters because it eliminates counterparty risk precisely when systems are weakest. This lesson extends far beyond any single asset. We are moving from an era of efficiency to one of resilience, from just-in-time assumptions to just-in-case reality. Markets will increasingly reward those who act early and penalize those who wait for comfort. The goal is not panic, it's clarity. Understand what you truly own, what you're merely promised, and what you actually control, and position yourself accordingly while options still exist. If this changed how you see the market, subscribe to the channel, share this with someone who needs it, and comment. 1, if you're preparing, or 2, if you're still waiting.